All right, so work together 14.3. Ladies and gentlemen, yesterday we went through and learned about our worksheet. And I just want to review a couple things about what we did yesterday first. Dividends. The first thing we did in 14.1 was we took a look at declaring dividends and paying dividends. Dividends is what a corporation gives back to its stockholders because they invested into the business. Does a business always have to pay dividends? No, they don't, okay? And the dividends are going to be declared as their earnings per share, so meaning how many shares you own multiplied by what they're giving per share. Okay, so that has to do a little bit of calculations. We did two transactions. The first transaction was to declare the dividend. We debited dividends, and then we credited dividends payable in our general journal. Then, at another date in our example from yesterday, it was 1 month later, we went through and paid that dividend. And we did that in our cash payments journal. We credited cash, and then we debited our dividends payable. Now, one of the big things we do when we have a worksheet, which is our first financial statement that we create, but it's not a permanent one. We only use it to get ready for our permanent financial statements, is to do our worksheet. Our worksheet has 8 columns, okay? The first set of 2 columns, our debit and credit, is going to be our trial balance. The purpose of a trial balance is to make sure that our debits and credits equal after we post. Because when we journalized, at the very bottom, we made sure that our totals proved, and that's how we proved our debits and credits. We took information from our journal and put it into our ledger, but we don't know if we made a mistake posting. We figure that out when we do our worksheet trial balance. If your debits and credits do not equal, stop and get them to equal. Don't do anything else in the worksheet. We did do a couple adjustments yesterday. The adjustments that we did yesterday were the same types of adjustments that we did previously, and that was for supplies and for insurance. Those are the most common mistakes made when we go through and complete our worksheet, because a lot of times students will take a look at the number they gave you for the adjustment and physically put that in the adjustment column, but that's not correct, because it always says that's the value of supplies inventory. So you have to calculate how much is used up. So don't forget that. When you do an adjustment, you have to have a debit and a credit. So if you're crediting supplies, you're going to need to debit that expense. Okay? The new adjustment that we're going to be doing today is going to be merchandise inventory. So now, I am a merchandising business, meaning I buy products, I turn around and sell it to our consumers. When I buy new products, what account is affected? Purchases, ding, 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 awesome, you are right. So if I buy products that I'm going to turn around and sell, I debit the account purchases. Would you agree? All throughout the year, anything that I buy, I put in purchases. Purchases is a temporary account. It has a zero balance at the beginning of the fiscal period. Throughout the year, I buy more, buy more, buy more, buy more, buy more, and I know then at the end of the fiscal period, the balance in purchases is all of the value of the product I got this fiscal period. Does that make sense? Now, we also have an account called merchandise inventory. Merchandise inventory is an asset account. It has a debit normal balance. The purpose of merchandise inventory is to give us the value of merchandise on the first day of our fiscal period. Okay? So when we take a look at it, we've probably been in some businesses at various points that go through and do inventory. Have you ever seen a business that goes through and does inventory? Like sometimes at Don's they go through and they'll have people and they have scanners and they put things in little belt things, or I've been at Shopko or Kohl's before where they said the racks are marked, this aisle is done, or don't mark this, or don't inventory this or that. Businesses have to go through and record physically what they have. The school store is working on that right now as well. They go through twice a year and they physically count inventory just to make sure that what is in the books is actually what is physically in the store. Now, there could be reasons why they don't match up. I've told you about Forrest. Forrest loves pickles, right? We go to Don's. He runs up, grabs a jar of pickles, but they're heavy. What happens? Breaks them. Okay. Do I have to pay for them? Usually not. Okay. Going to other stores, if they break something, sometimes I have to pay for it. But at Don's, they'd clean it up, and I wouldn't have to be charged. But Don's is now out that jar of pickles, right? So we have to account for those types of things. We also have naughty people that try to steal stuff. Okay, so you have to deal with theft, damage, loss, any of those types of things, which happens during a fiscal period. Okay? At the end of the fiscal period, somebody will go through, the business will go through, and they'll give you the value of inventory. Now, Can that value of inventory be higher than what it was at the beginning of the year? Yes, why? Not supplies. We're doing products. Yes. Okay. Merchandise. Merchandise is what we're turning on and selling. So at the beginning of the fiscal period, if I had $10,000 worth of product, if throughout the fiscal period in purchases I went through and debited another $70,000 worth of product, and then I go through and see maybe I didn't sell as much as I thought, and I could actually end up at the end of the fiscal period with more merchandise inventory than I had at the beginning, because throughout the year I buy more and buy more and buy more and buy more. So we have to go through at the end of the fiscal period, the last day, and right now we're going to do a fiscal period of January 1st to December 31st. So on December 31st, they're going to go through and say, all right, here's the value of our merchandise inventory. It can be higher, and that's okay. It's not like something's wrong. They just realize they purchased more inventory than what they sold, so the value of our inventory is going up. Or maybe they have a big sale or something's going on, they're expanding, so their merchandise inventory goes up. It doesn't mean they've done something bad. Will just be different. So when we look at Work Together 14.3, it says a physical count of the inventory for our business has determined that we have $234,904.20. We have to analyze the adjustments and enter that adjustment on the worksheet. Now, merchandise inventory on the trial balance, that balance is the value of merchandise on January 1st, the very first day of our fiscal period. They gave us the value at the end, so we have to find the difference. Is the value of merchandise inventory going up or down? Down. So are we going to debit or credit merchandise inventory? By the difference. Okay, so go ahead, use your handy-dandy little calculator. I'm going to put in 248,752 minus the 234,904.20, and I got 13,845.80. You guys agree? Now, it's pretty obvious what other account we're affecting. What's the other account we're affecting? Income summary. So income summary is going to be the other account that we use when we're adjusting that. Did I have the wrong sense? Like that? Mm-hmm. Thank you. This is where life didn't work the third hour. Oh, good, it worked. Try the on your own. It's really hard. So 14.4, because I'm hoping it didn't take you very long to do the on your own. Hate to tell you this, but sometimes we have customers that don't pay us back. In our perfect accounting land for Unit 1, customers that bought on account paid us. And we didn't think about maybe they wouldn't. But in the real world, we're going to have people that are not going to pay us back. Okay? So we have an account called the Allowance for Uncollectible Accounts. And right now, for our coastal aquatics, they're going through and telling us that we are going to estimate that for all of our sales on an account. Now, sales on account is different than my sales account. It sounds similar, but sales account is my total sales for people paying cash or if they buy on an account. So sales on account are only the people that came to us and said, I'm going to take this product, but I'm going to pay you later. But Coastal Aquatics has determined that 0.5% of our sales on account are not going to pay us back. So why would a business do sales on account then, if they know they're not going to get all their money? They're not going to get interest rate. Would I be able to, with Pepsi, get product if I didn't do it on account for the concession stand? No. So it's one of those things that has to happen in the world of business. And we just, when you take a look at it, it's the cost of doing things. So they're saying they have 0.5% of their sales in the account not going to pay us back. So what we have to do at the end of the fiscal period is we know that Coastal Aquatics has had sales in account of $424,000. So they're saying 0.5% of that is going to be uncollectible. So what we have to do is we have to journalize that adjusting entry. So we would go through and do allowance for uncollectible accounts would be credited, and then we would debit allowance uncollectible accounts expense. And the reason that we have to do it on December 31st as our adjusting entry is we had $424,000 worth of sales this fiscal year, and we have to do matching revenue and expenses within the fiscal period that it happens. So we can't wait until it happens and then write it off because we're assuming that it's going to be 0.5% of this year's sales. So when I take $424,000 times 0.5, what number does it give me? And that's what I heard. That's what I heard. 2,120? So I'm going to credit allowance for uncollectible accounts, and then after that makes it pretty obvious, we're going to debit uncollectible accounts expense. Okay, so credit allowance for uncollectible accounts. Now please notice, allowance for uncollectible accounts is directly below accounts receivable. Allowance for uncollectible accounts is a contra account to accounts receivable. It has the opposite normal balance of its controlling account. Does that make sense? So accounts receivable has a debit balance. Allowance for uncollectible accounts, because it takes away from the balance of accounts receivable, has a credit. That was 14.4. Did you try on your own? If not, check it out. It won't take you very long. 14.5. This was our last one for today. 14.5 deals with depreciation. Have you heard that word or phrase before? Maybe. Like in life, have you heard of depreciation? The one that I think kids hear about the most for is going to be about your car. The more you drive it, what happens? The less it works, right? Now, there are some things that appreciate, go up in value. Do you know anything that goes up in value? Yeah. No, not going to talk about the stocks. Something famous, something that Mrs. Gressel owns. I'm famous, right? What would appreciate? Land. Would you agree? You buy land, and what happens over time? The value of it goes up. As long as you maintain your home, what do you expect? The longer you own your home, what should happen? Should go up. It needs to be maintained, though. You can't do anything to it and then have it be run down. Those types of things will go up in value, but general things that we buy and we purchase are going to go down in value. For example, at the beginning of the school year, they gave me a new projector. Yep, so I've had a new projector this year, which is nice because it's nice and bright. It has lots of good lumens, which means I don't have to have all the lights off for you to see the board, which I appreciate. Now, if I were to sell this projector today, could I get the same value that I paid for it? Probably not. Why? It's used, right? It's gone down in value. The light bulb's not as worth as much. So what we have to do every year, a business needs to go through and look at their assets and figure out how much did the asset go down. Now, there are lots of assets in this building or in this room right now that we would have to depreciate. Every single computer in here depreciates every year. Chairs depreciate. Okay, think about it. I buy that chair. Let's say the chair was $125. If I turn around and sell that chair today, can I still get $125? No. Could I maybe get $20, $30? Certainly. Monitors, keyboard stands, bookshelves, those types of things are going to be, we buy it at one value, and then we go through and they would depreciate. Okay, so we have two types of plant assets that are going to need to depreciate. We have office equipment and we have store equipment. Two different locations. The office is going to be what helps them run and maintain the business, and the store is going to be where the customers come in. So what they said is they've calculated depreciation expense for a computer printer costing $1,600. The estimated salvage value is $100 with a useful life of 5 years. Okay, what does that mean? What they say is at the end of its useful life, you should be able to sell it for $100. That's what they would estimate. Okay, so every year they own it, they have to depreciate it the same amount. So it's going to have the same amount. So how much will it depreciate over its entire life? What's that? $1,500. Do you see how we found that? Beginning price minus the salvage value. Okay, so $1,600 minus $100 is going to give me $1,500. Now, how many years are we going to own it? 5. So if I take $1,500 and divide by 5, that would give me how much it's going to depreciate each year. Does that sound good? Okay. So year 1, how much does it depreciate? $300. Would you agree? Book value. Okay, now stay with me. This one's a little bit harder. Book value is the original price minus its total depreciation. So at the end of year 1, what is my book value? What's that? $1,300. Stay with me. $1,600 minus the depreciation for year 1, which would give me $1,300. Would you agree? Now, year 2. What's my total depreciation at the end of year 2? $600. So my book value would be $1,600 minus $600. So my book value would be $1,000. Are you following me? Okay. So number 2, it says calculate the book value of the computer printer at the end of its second year of life. Well, the end of the second year of life is $1,000. Got it? Is there a spot on the bottom that you're supposed to be calculating this? I just walked you through, like, mentally how to do all of that, but they do have a formula spot on the bottom, so I'm going to guide you through that as well. Original cost is $1,600. Salvage value is $100. That'll give us a total depreciation of $1,500. Divide that by 5 years, which will give me an annual depreciation of $300, which is what we all talked about. The original cost is $1,600. You depreciated $300 year 1, $300 in year 2, which is going to give me total depreciation of $600, which will give me a book value of $1,000. We mentally did all of that, but that just shows you, like, mathematically how we did it. Okay, instruction number 3. On December 31st, Coastal Aquatics determined the total depreciation of office equipment is $6,120, $5,060. Now, I want you to think about this for a minute. Bless you. Do you see year 1, this $300 that we calculated here? They would do that. A business does that for every asset they own. They go through and determine this one depreciated 100, this one depreciated 100, this one depreciated 200, 300, and they have to add all of those depreciations together, and all those depreciations together is going to give you your annual depreciation for that year. And they went through right here and told me for office equipment, the total amount of depreciation for this year is $6,120. The total amount of depreciation for store equipment is $5,060. Now, this is where students get confused because I'm actually putting that number in as the adjustment. So, accumulated depreciation office equipment, I'm going to put in $6,120 because that's what happened this year. And then my debit is going to be my accumulated depreciation office equipment expense. Depreciation expense for store equipment is going to be $5,060, and then I'm going to debit my expense for store equipment. I got a perfect. Try the on your own.